2008 was a tumultuous year for the economy. The housing market collapse created one financial crisis after another, and it often seemed as if the news could only get worse.
And ultimately, our country could experience a long and painful recession. Fellow citizens, we must not let this happen.
Now, in predicting when and how the collapse would occur, my focus was again on the actions of our government.
What I think people are most upset about is that nobody went to jail. You know, if people had gone to jail, they wouldn't be quite so upset about the financial crisis.
Another part of what drove this was belief that home prices would never go down.
The Big Short, with its all-star cast, recounts the events of three groups of traders that bet against the housing market in the years before the subprime mortgage crisis that would eventually result in the failure of key financial institutions.
People have sort of a cursory knowledge of what happened in 2008, but when you start peeling away the layers of the fraud, it's incredibly terrifying.
The Big Short is unique as a high-budget Hollywood production that actually takes the time to properly portray the way that finance really worked behind the scenes, and uses financial events to progress the plot rather than focusing on wild parties, sports cars, and sexy ladies like some other equally fantastic movies that took a very different approach to storytelling.
The real question is this: was all this legal? Absolutely not.
Similarly to The Wolf of Wall Street, The Big Short is a movie based off of a book. Only The Wolf of Wall Street was an autobiography written by Jordan Belfort himself, and The Big Short, Inside the Doomsday Machine, was a standard non-fiction title that described the role of several players in the creation of the credit default market betting against the American housing market.
A bunch of people who borrowed money to buy a house, and are they going to pay off their loans or are they not? And the vast majority of the financial system was betting yes, that they're basically going to repay their loans, and some people bet no.
The Big Short was written by Michael Lewis, a veteran financial journalist, and the book really does read like a 320-page financial article, in that it's very information-dense, but also very well researched and verified. For this video, we will only be looking at the players that are in the movie, but the book does go into detail on some people that were either entirely cut from the film or merged into other characters to make the movie entertaining to a broader audience. Unfortunately, in the process of making it as appealing as possible to cinema goers, the movie did cut out some very important details, and also just straight up got some things wrong.
The biggest disadvantage we had was about the financial instruments and how to explain them. That was really the problem I saw. I thought the characters were incredible.
So it's time to learn how money works to give you guys an investment banker's insight into what really happened in The Big Short. The Big Short told the story of three main partners who took a short position or bet against the American housing market and the financial system that had grown around it in the early 2000s. The first of the three was the now infamous Michael J. Burry, a physician who gave up being a medical doctor to start a hedge fund, Scion Capital, in 2000.
Dr. Mike Burry, yes he does.
Burry had a lot of success in the hedge fund by shorting overvalued tech stocks and returned an average of 25% to his investors over the first 4 years, which is incredible. By 2004, he was managing $600 million for investors, which meant with his returns, he was making about $30 million a year for himself from a traditional hedge fund fee structure of 2 and 20. This means that the hedge fund manager was making 2% of all assets under management no matter what. So 2% of $600 million is $12 million, and 20% of the returns generated over the market. 20% of the excess returns he was generating at this time would have conservatively made him $18 million. His fund was so successful that by 2004, he stopped accepting new investors because his strategies relied on being able to move in and out of markets without influencing the markets themselves with huge order values. The Burry depicted in the movie was a bit of an eclectic guy, but it probably didn't do a great job of showing that he was already extremely wealthy by this point. Steve Eisman, played by everybody's favorite regional manager Steve Carell, had also managed a hedge fund, Front Point Partners, but his name was changed in the movie to Mark Baum. Eisman and his team also worked with Greg Lippmann, a Deutsche Bank trader, who was also betting against the housing market and was portrayed in the film by Ryan Gosling, with his name changed to Jared Vanette. And last, there is Cornwall Capital, renamed to Brownfield Capital in the movie, which had a much smaller pool of capital at play, but ended up generating the highest returns because of a clever play that will make sense by the end of this video. Burry's Scion Capital, Baum's Front Point Partners, and Brownfield Capital all had a problem. They wanted to short the housing market, but that's not possible to do directly. A short position normally works by temporarily borrowing an asset and selling it immediately for the current market price with hope that it will be less in the future. If the price does fall, the short seller can buy back the asset, give it back to the person they borrowed it off of, and make a profit on the difference between the sale price and the purchase price. That's much harder to do with housing, because nobody is going to let you borrow their house to sell it. All of the parties therefore ended up using credit default swaps. Credit default swaps sound complicated, but they are nothing more than regular insurance contracts that you would have for your car or your house. Car insurance is a contract between an insurance company and a car owner that promises to pay out in the event that the insured car gets into an accident. A credit default swap is an insurance contract between an insurance company or an investment bank and the owners of an interest-bearing asset like bonds or mortgage-backed securities. Mortgage-backed securities are supposed to pay out a fixed rate of return to their holders, and if they don't, the insurance company will pay out to make sure they are covered. What Michael Burry was doing in this scene was basically taking out insurance on a car he didn't own. If that car crashed, he would be able to collect the payout even though he never owned the car in the first place. Now replace the car with mortgage-backed securities and you should understand how this scene plays out. The problem for Burry is that he took out a lot of credit default swaps, and just like getting a lot of car insurance, he had to pay out the quarterly premiums on these policies to keep the coverage up. If the mortgage-backed securities never crashed, he would never get a payout, and he would have spent all of his investors' money on the Wall Street equivalent of Geico premiums. One thing that the movie doesn't quite get right is that Burry later tells his investors that he had a number of Wall Street banks create these credit default swaps, insinuating that taking out insurance on mortgage-backed securities was a totally new thing that Burry came up with. Credit default swaps, the insurance contracts, had actually been used since the 1990s, and they were used for a really interesting reason. Mortgage-backed securities were a collection of thousands of mortgages all put into a single pool to be sold off as a low-risk investment to other institutions. Selling these mortgages onto other investors gave the banks making these loans more cash so they could give out more mortgages, which Washington really loved, because it gave more people the opportunity to be homeowners. Making mortgage-backed securities and then selling them on the market is, however, a slow and complicated process done by lawyers and bankers who need to make sure thousands of mortgage contracts are properly accounted for in every single new mortgage-backed security they made. Most lenders outsourced this tedious process to bigger investment banks. This meant that the investment banks had to buy mortgages from the small banks and then keep those mortgages on their books for the 2 or 3 months it would take to properly package them as a new financial product. During that time, the bank ran the risk of those mortgages defaulting, which would cost them money. Normally this wouldn't be a huge deal, but the scale of mortgage-backed securities operations meant that some of these banks had trillions of dollars worth of mortgages on their books at any given time, which presented risk well above their tolerance. The investment banks didn't expect anything to go wrong, at least when they first started making mortgage-backed securities, but you also don't get car insurance expecting anything to go wrong. You get it because a car crash could cost you more than you could afford if you were unlucky enough to be involved in one. Credit default swaps let the investment banks keep trillions of dollars worth of assets on their books and collect their fee for making these products without the risk of anything going wrong. Unless, of course, a company like AIG, which was writing all of these insurance contracts, became insolvent. But that wasn't really seen as a possibility.
These private insurance contracts were called credit default swaps and would ultimately expose the giant conglomerate to $64 billion in potential subprime mortgage losses. And when the housing bubble burst, AIG didn't have enough money to meet its obligations.
Back to Michael Burry. He started taking on these insurance contracts in 2005, which was 3 years before he would eventually cash them out for a profit of over $800 million. He took insurance on some of the riskiest of mortgage-backed securities, which is the next mistake the movie made. It heavily implied that these financial products never went wrong prior to 2008, which they did, especially the riskier securities. This is why the insurance contracts existed in the first place.
In other words, we lose millions until something that's never happened before happens?
That's correct.
Riskier assets would command higher premiums.
And the premiums?
Well, we pay roughly 80 to 90 million each year, which is high, but I was the first to do this trade. Watch, it will pay. I may have been early, but I'm not wrong.
A 22-year-old with a DUI will pay a higher premium to insure their 2004 Subaru WRX than a 45-year-old with a perfect driving record will on their 2022 Civic. It all comes down to the chance that the insurance provider will need to pay out. In a later scene, we see Mark Baum's hedge fund front point by credit default swaps on BBB-rated mortgage-backed securities. A BBB rating means that these assets are risky and have approximately a 1% chance of failure in a given year according to rating agencies. Mortgage-backed securities could become safer or riskier in 2 ways. The first way is if they were just full of really safe mortgages of people with high incomes, good credit scores, and low loan sizes relative to the value of the homes. By the early 2000s, these didn't really exist, and good borrowers were mixed together with bad borrowers altogether.
I think it was, in fact, in retrospect,
a great big national, and not just national, global Ponzi scheme.
Banks instead made their products safer or riskier by layering them into tranches. Imagine 3 buckets that could be filled up with cash. The cash would come from the payments that people would make on their homes. All of this cash would go into the top bucket first, and then would overflow into the second bucket, and then to the third, and so on. The final bucket is the last to get paid, so it's the cheapest to buy, which means buying this bucket could generate a really good return on investment. If everybody is paying their mortgages, all of the buckets get filled up, and all of the investors get paid their money. If some people don't pay their mortgages, the last bucket in line might make nothing. But that's the risk that investors seeking higher returns would take. Structuring the mortgage bonds and cascading buckets for money created some desirable properties for investors. The first bucket would be much safer than any generic mortgage ever would be by itself, and the last bucket would offer higher returns than the interest rates on the loans. This created a market for risk-seeking investors and conservative investors, all with one asset class. The diversification that came with blending thousands of mortgages together into a single flow of money meant that returns were much more predictable, which gave a few Wall Street guys an idea. If you could mix together lots of mortgages, maybe you could do the same thing with lots of mortgage-backed securities, which themselves were a mix of a lot of mortgages. This was a collateralized debt obligation, or CDO. The thesis for these financial products was that they offered safety through diversification by getting returns from lots of risky mortgage buckets. They expected 1 or 2 of these buckets to fail, but those losses would be made up for by the high returns generated by the thousands of other buckets that they put into the product. A lot of these CDOs were also layered with their own buckets, and you might be able to see where this is going. Some firms took the lowest buckets from these CDOs and mixed them together to make new CDOs, which became known as CDOs squared. The diversification that came from mortgage-backed securities did protect investors from the risk that a single mortgage would default, or that even an entire region would default, but no amount of diversification could protect the system from the hose of cash feeding the entire system being shut off like it was in 2008. Fortunately, it was possible to take out insurance on any of these buckets that investors wanted by using credit default swaps. Now that you know the difference between mortgage-backed securities and collateralized debt obligations and how these products work, I can also point out one other little mistake that the movie made. In the sequence where Michael Burry goes between the investment banks trying to get them to write insurance contracts on mortgage-backed securities, he hands his counterparties a prospectus on the mortgage bonds that he would like to short.
I have prospectuses on 6 mortgage-backed securities I want to short.
Dr. Berry, these should be fine.
Yeah, we're prepared to sell you $5 million in credit default swaps on these mortgage bonds.
Can we make it $100 million?
Absolutely, we can make it $100 million.
The real Michael Burry actually took out swaps on collateralized debt obligations, which were the buckets made from the lots of other buckets.
Right, we bought basically short $8.4 billion of credit default swaps related to mortgages or financial companies.
You must have been pretty confident that this thing was going to blow up.
Well, we had a giant bet for us, and I was extremely confident in the outcome.
Were your investors as confident?
It's not a big mistake at all, but it's something you can annoyingly point out to your friends next time you decide to watch this movie. The finale of The Big Short plays out as the now infamous events of 2008 start occurring, and the incredibly complex financial products that these 3 parties have been betting against start falling in price. At this point, Brownfield, Scion, and Front Point had 2 ways to turn their short positions into cash. They could wait for the assets that they bet against to collapse and collect their insurance payout, or they could sell those insurance contracts back to the banks that were now desperate to get back that security.
It's Dr. Burry. Looks like the collapse of the financial sector is imminent. I start to sell my position. It's $1.3 billion.
They all opted for option 2, because as Michael Burry alluded to in an earlier scene, there was a possibility that these institutions would collapse, and they would never be able to collect on the payouts that were owed to them.
You want to bet against the housing market, and you're worried we won't pay you.
Yes, that's right.
This would be like if you crashed your car, only to find out that Geico had gone out of business before you could claim your insurance money. The reason that Brownfield was able to make much higher returns than Burry and Baum was because they bought insurance contracts on the assets that were much safer, the A and AA buckets instead of the BBB buckets that the larger hedge funds were buying. Because these assets were safer, the premiums on insurance contracts were lower, which meant that the pair could buy more with them with the limited pool of investor money they had.
This is what we did that no one else thought of. Not even Baum or Berry thought to short the AAs. But we did.
The final mistake I think the movie made was that they didn't do a great job of saying that almost all AAA mortgage-backed securities and more than 90% of A and AA securities did not fail, which meant that Brownfield wouldn't be able to collect on their premiums. But because the banks were so desperate to get their hands on insurance, as the financial system was unfolding, they were able to sell the contracts that they paid very little money for back to the banks at a huge premium. In the aftermath of The Big Short, all of the parties were left with a lot of money. Scion Capital was shut down immediately after because Michael Burry made so much money that he could support himself by just managing his own capital rather than dealing with the stress of outside investors, which was portrayed very well in this movie. This is called a family office, and the movie said that he only invests in water, which isn't true. And he has famously traded some well-publicized short positions in Tesla, as well as Cathie Wood's ARK Innovation ETF. None of his trades to date have been as successful as his one in The Big Short. Brownfield, which is really Cornwall Capital, still operates to this day, and has $262 million in assets under management according to their most recent Form 13F, down from their all-time high of $1.4 billion. But it's possible that this drop is due to investor withdrawals, not investment losses. America's angriest hedge fund, Front Point Partners, was shut down in 2011 after one of its senior managing partners, Chip Skowron, played loosely by Jeremy Strong in the film, pled guilty to insider trading and was sentenced to 5 years in prison. These hedge funds made billions of dollars by executing The Big Short, but to some companies, that's less than they make or lose every single day. If you want to learn about companies managing trillions of dollars, you should go and watch my video on Blackstone and BlackRock to find out how they work and if they are the evil empire secretly pulling the strings of global finance from behind the scenes. A special thanks again to Blinkist for making it possible for everybody to keep on learning how money works.
For sale, 742 Evergreen Terrace, detached single-family dwelling. Now, who'll start me off? $500. Sold.